The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, markets are navigating a period of heightened volatility and economic cross-currents driven by unprecedented trade policies, a shifting global monetary landscape, and fading U.S. exceptionalism. Now, that's according to the latest report by PineBridge Investments, investing amid peak uncertainty across asset class view, which outlines the risks and emerging opportunities across equities, fixed income, and multi-asset strategies. So how should investors interpret this evolving macro environment? Which asset classes are best positioned to weather the turbulence, and where might the biggest mispricings lie? And as policy responses lag behind fast-moving market shifts, what role should active management play in navigating the uncertainty? Well, to find out more, joining me now is Hani Redha, who is a portfolio manager and head of strategy and research for global multi-asset at PineBridge Investments. Hani, welcome to the show. Thank you so much for joining me.
Good afternoon. Good to be with you.
All right, Hani, looking back here, President Trump's sweeping tariff announcements on the 2nd of April shocked global investors, unleashing volatility across asset classes and raising fundamental questions about U.S. stability. So how do you interpret the long-term implications of Trump's historic tariff policy on global trade and economic stability?
Before I go into that, I want to just point out that we're in an exceptionally volatile period, so very difficult to have high conviction in long-term implications because things are so fluid. But we'll base our views on the information at hand and how we think things are going to evolve based on what we've seen so far, which has already materially shifted just over the last week or so. But overall, I'd say that the Trump administration really represents a shift that's happening in America that requires a kind of rebalancing of the global order, at least to some extent, in a direction that supports the U.S. to become more sustainable, both in terms of its own finances and its defense arrangements around the world, but also to favor creation of jobs and sectors that have been neglected over the last few decades. And so this is what we're seeing happen, is a shift in that direction.
Right. Well, Hani, based on your report, it suggests a 40% chance of a mild recession here. What key indicators are you watching to determine whether we're heading in that direction?
Sure. I would say it's 40%, but it's falling right now as a risk of recession as a result of what we've seen over the last few days in terms of a de-escalation, particularly between the U.S. and China. So 40% was not, that would tell you that recession wasn't our base case. And I would say that the probability is falling. But to stay on our toes and be sure that we don't miss anything, the probability is still uncomfortably high. The key thing to watch is the labor market. That's really going to be the key determinant. Sometimes we see, negative GDP prints, which technically may, register as a recession. But unless you see the damage in the labor market, it doesn't really count and it won't be a particularly major problem. So I would watch hiring rates and then even more importantly, any kind of layoff data such as initial jobless claims. Right. Those are the areas to watch for any signs of trouble.
Well, as we, head into that with that outlook, will the Fed cut rates 3 times over the next 12 months?
Yeah, so in a scenario where we don't end up in a recession, we probably don't see that many cuts, maybe, more like 1 or 2, because there's less of a need to, be supportive of the economy. So I think that the Fed is still biased to cut. They will need to be patient because, the impact of tariffs is stagflationary, right? It pushes inflation up and it pushes growth down, and those are both bad outcomes. And the Fed is supposed to be trying to control both inflation and unemployment. And so it's a challenge to them. So I think they have to be patient and allow the inflationary impulse to at least peak before they can move. But I think they're still biased to cut rates as early as they can once they are comfortable that the inflation is not going to get out of hand.
Well, also according to your report here, Hani, U.S. exceptionalism is clearly fading for short term, and risks are rising for investors either hedging the U.S. dollar or rotating away from U.S. assets. So given the fading U.S. exceptionalism, what weight would you currently assign to non-U.S. assets in a diversified portfolio?
Yeah, so I would say that it's very important to recognize, at least in our opinion, that the fading of so-called U.S. exceptionalism is fairly temporary. We think that the U.S. will continue to be an outperformer over the medium to longer term. But perhaps as a result of these changes that are happening, it may be just less exceptional. Not necessarily outright unexceptional, but just less exceptional. And that argues to have a bit more diversification in the portfolio compared to the recent past. The interesting thing for us is that there finally are some interesting alternatives to the US that can be added to a portfolio, not necessarily at the expense of US equities, but in addition to US equities.
Right. How do you view the relative attractiveness of European credit and Asian USD credit as alternatives to US fixed income then?
Yeah, we actually find some interesting pockets there. In Asia, we really favor high yield exposure, actually. We find that to be quite a unique market, very uncorrelated to global factors. You know, it tends to be a very idiosyncratic group of issuers in that market, and so you are paid quite well in terms of yield, and it's a market that is a bit less commonly invested in, and so can give you good diversification. I should say though, it's important, and you did mention, active management, that this is a market that you really should approach through an active approach rather than just passively. And then within Europe, this is one of the positive impacts that Trump has had, is to actually awaken the Europeans, and particularly the Germans, from a 50-year coma and increase their fiscal spending, which could be quite supportive of European credit. And in particular, we like European bank loans.
Okay. Well, then, should investors increase their interest in industrial equities amid post-COVID trends and AI-driven automation? I mean, what benefits do industrial equities offer at the moment?
Sure, yes. That's one of our conviction areas, in fact. And it's a result of a couple of different factors that are coming together to be quite supportive. In this kind of post-pandemic environment, we're seeing a lot more investment activity and intentions in the industrial space compared to the previous cycle. And that surrounds, higher defense spending, for example, which is, falls under industrials as a sector. You will see more reshoring of industrial production towards the US. And that's also quite supportive of companies that are active in that space. You have the AI-driven spending, which we think is very real and still early stage and requires a lot of industrial build-out. All of these things are combining to form an environment that is quite supportive for industrial equities, much more so than we saw, in the years post the GFC. And the last one to add to that is climate investing. That is still happening in the background. So all of these factors create a positive environment for that particular sector.
Meanwhile, the report also points out that healthcare is facing multiple headwinds, from tariffs to policy changes. So should investors then stay underweight on the sector, or are there overlooked opportunities in the sector?
Yeah, overall, we think that's a sector that's quite challenged and has some headwinds coming from a lot of policy interference, you could say, requiring companies to produce in the US, which may be more costly for them, There's a lot of pressure on drug pricing in the US as part of their plans to try to put the fiscal finances in order. There's just a huge spend on healthcare, products such as, pharmaceuticals from the U.S. healthcare system. And those are under threat right now. And so that's a sector that is very difficult to have an edge in understanding where that'll settle. And that's why we think it's better to avoid. There are better opportunities elsewhere.
Well, uncertainty has indeed produced volatility of volatility, as highlighted in your report. So, Hani, in times of volatility, how would you rebalance a multi-asset portfolio to protect downside risks while remaining opportunistic?
Yes, it's a challenging environment in that sense. When inflation was low and persistently low in the prior regime, we were quite spoiled because monetary policy was the only game in town, and the central banks were pumping in liquidity, and that was suppressing volatility and actually making it very conducive for multi-asset portfolios. We're now in a very different world,
right,
where monetary policy is going to be tighter because fiscal policy is so much more assertive. And so, yes, it's going to be a very volatile environment, and the volatility itself will be volatile. What we think you should do there is look at hedging different types of risks, such as stagflation, through the use of other instruments, and not only relying on government bonds to protect your portfolio.
Right. Well, on that note then, should investors continue to place gold as hedges against stagflation?
Yes. To us, that's really top of the list. Gold has proven already to be quite effective as a hedge for stagflation and for broader geopolitical shifts. This kind of reordering of global trade and the alliances that we see forming on the global stage mean that the U.S. dollar is going to be under more scrutiny and is going to have some challenges because there's a kind of de-dollarization trend that is definitely underway and is likely to persist over the medium term. And gold is really, to us, the best hedge we can find for that type of risk.
Well, overall, Hani, before we let you go here, if the current de-escalation phase, fails and tariffs persist or worsen, which asset class do you expect will suffer the most and which might benefit unexpectedly?
So an environment where we go back to escalation, we already kind of saw what kind of pain that can create, in the first few days of April. The challenge is that a stagflationary type of environment is very challenging for most financial assets. The typical 60-40 type of multi-asset portfolio doesn't work well because that environment challenges both equities and bonds. And so that's an environment where gold, again, is going to be a main beneficiary at the expense of both equities and bonds. But at the same time, I think cash itself can also be part of a way in which we can protect portfolios, at least in the near term, until the storm passes.
Right. Well, thank you so much for your time and your insights today, Hani.
Great to be with you.
Thank you. That was Hani Redha, who's a portfolio manager and head of strategy and research for global multi-asset at PineBridge. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.